All right, welcome to The Explainer. Today, we are unpacking the biggest, most talked about stock market debut of 2025. And trust me, the story is not what you think. So, Medline, a real giant in the world of medical supplies, just went public, and they raised an absolutely staggering $6.26 billion. To put that in perspective, that makes it the largest IPO of the year, and it's not even close. Now, your first thought is probably the classic story, right? The private equity firms that bought the company a few years back are just cashing out, taking their profits, and running. But, well, the reality here is way more interesting than just a simple payday. Yeah, this was not about the owners heading for the exits. This whole IPO was a really clever, carefully planned move designed to fix a massive problem that was lurking on Medline's balance sheet. To really get what's going on, you have to rewind the clock with me back to 2021. That's when Medline was taken private in what was one of the biggest deals of its kind ever. So after being a family-run business for decades, this group of private equity heavyweights, we're talking Blackstone, Carlyle, and Hellman & Friedman, they bought a majority stake in Medline, and they did it using a classic tool called a leveraged buyout, or an LBO. An LBO is kind of like buying a house with a huge mortgage. You use a ton of borrowed money for the purchase, and the whole idea is that the company's future profits will eventually pay off all that debt. But the key here is the sheer scale of the borrowing was just immense. That 2021 deal left Medline holding a mountain of debt. We're talking nearly $17 billion. I mean, that is a huge financial weight for any company. It just puts a drag on everything. So how could a company with that much debt be so incredibly valuable? While Medline was valued at over $54 billion in its IPO, the answer to why, it all lies in their unique and, as it turns out, wildly profitable business model. See, unlike most of its competitors, who are basically just distributors, Medline is really two businesses rolled into one. They've got a massive distribution arm, but that's a low-margin business. The real magic is in their own manufacturing business, the Medline brand, which makes their own products and has an unbelievable 26.1% profit margin. And this, right here, is the absolute key to understanding the whole thing. That high-margin manufacturing part of the business is the true profit engine. It generates over 85% of the company's entire profit. So you see, this isn't just a distribution company. It's a high-margin medical products powerhouse that just happens to have its own logistics network. Okay, so you've got this incredible profit engine, but you've also got this giant debt problem. So how exactly was this IPO engineered to be the perfect solution? The company was completely open about it. They made it crystal clear what the IPO was for. The main goal? Take a giant chunk of that money they raised, $4 billion, and use it to immediately pay down their loans. And the effect was just instant and dramatic. In one move, they slashed their total debt from around $16.8 billion down to $12.8 billion. They basically used the public markets to perform major surgery on their own balance sheet. It's pretty incredible. And this deleveraging was so huge that the big financial health referees on Wall Street, the credit rating agencies like S&P and Moody's, they took notice right away. Both of them signaled that Medline's credit rating was probably going to get an upgrade, which is a huge vote of confidence in their new financial stability. But what's really fascinating is how having a stronger financial footing like this directly translates into a much sharper competitive edge out there in a really tough market. When you look at their main rivals, like Cardinal Health or McKesson, they're mostly playing in that lower margin world of distribution. But Medline's model of making and selling their own stuff, well, that gives them this powerful, built-in advantage. The healthcare industry is consolidating fast, which means hospital systems are getting bigger and they have more power to demand lower prices from their suppliers. For a pure distributor, that's a total nightmare. But for Medline, those high-margin products they make act like a shield, letting them absorb that pressure and protect their profits. So, after peeling back all the layers of this record-breaking IPO, what's the one big thing, the single most important insight you should walk away with? A due diligence report on this deal just said it perfectly. The private equity guys and the founding Mills family, they made a very deliberate choice here. Instead of just cashing out, they decided to repair and strengthen the company's financial foundation first. And that move just screams long-term thinking. This wasn't about a quick flip. By paying down $4 billion in debt, they made the part of the company they still own more secure, way less risky, and in the end, a whole lot more valuable for the future. It was just a masterclass in creating value. Which really leaves us with this final forward-looking question. Now that Medline has totally re-engineered its finances and shored up its competitive advantage, what's it going to do with all this newfound strength? Now that is a question the entire healthcare market is going to be watching very, very closely.